Equity investors have had a remarkably favorable backdrop over the last decade or so. Steady rates of economic growth, low and stable inflation, and falling interest rates. We've also had lower corporate taxation and a low-touch regulatory environment. And all of this has been a potent mix, which has led to very strong returns. Looking forward, however, we anticipate a number of headwinds. Most of all, the stage of the cycle. If we look at the high output gaps globally, the prospect of the US job market rolling over, a recession over the next 2 years is highly likely. And why is this relevant for a long-term investor? Our work looking at returns over the last 100 years suggests that even for someone with a longer time horizon, returns can be dictated by where we are in the cycle. For instance, investors in developed market equities who invest just ahead of a cycle can only expect 4% returns per annum over the next 5 years. Whereas those who invest after a recession at the start of a cycle, these returns could be as high as 10 percentage points. It is important to note that long-term expectations of inflation are still very well anchored. However, even though we do believe that inflation would come back into the comfort zone of central banks, this would be a gradual process. As a result, inflation over the next 5 years would still be higher than what investors are used to. Not just that, we think the volatility of inflation would be higher than before. An environment of higher than average inflation and heightened volatility of inflation is hardly a favorable backdrop for bond returns. Yields are still pretty low, and as monetary policy normalizes further, bond investors would be hurt by rising yields. We do, however, find US government bonds attractive, and this is primarily a function of the high coupon rates which are currently on offer. Outside of the US, we think there is very good value in emerging market bonds, both hard and local currency, and Chinese government bonds in particular, we believe offer one of the best risk-reward characteristics. We forecast the traditional 50-50 portfolio to only return around 2.5% per annum adjusted for inflation over the next 5 years. This is hardly half the long-term average. In order for investors to try and achieve the kind of returns they're used to, they need to make a number of adjustments to their portfolio. First, asset allocation decisions would have to be considered at a regional level. Secondly, investors would have to allocate more to equities outside of the US into emerging markets and along the lines of themes rather than countries and sectors. And finally, we believe that investors stand to benefit from a higher allocation to real assets and also to liquid alternatives. For the full analysis, the secular outlook can be found on our website.